Hello guys, welcome back. In our previous sessions, we explored the groundbreaking role of technological innovations like mobile banking and AI, product innovations such as microinsurance and micropensions, and new delivery mechanisms including agent banking and digital platforms. We even looked at the powerful impact of fintech on microfinance and saw how these advances are driving greater financial inclusion, efficiency, and outreach than ever before. But today, we are stepping into a critical part of the conversation: ethical issues in microfinance. So let's begin. Imagine Sita, a hardworking woman in a rural village who until recently never had access to formal financial services. Through microfinance, she received a small loan to expand her saving business. Her story is one of the millions that illustrates the power of microfinance in transforming lives. But as we dive deeper, we realize that microfinance, while a potential tool, carries complex ethical challenges as well. Microfinance has emerged as a critical tool for economic empowerment, poverty alleviation, and financial inclusion, particularly in regions where traditional banking services are inaccessible to low-income populations. At its core, microfinance involves providing small loans, savings accounts, and insurance products to individuals who are often excluded from formal financial systems due to the lack of collateral or employment records or credit history. The approach gained widespread recognition in the 1970s, largely due to the pioneering work of Dr. Muhammad Yunus and establishment of the Grameen Bank in Bangladesh. However, as the microfinance sector has grown and evolved, it has sparked debates regarding its ethic implications. What began as a movement to lift people out of poverty through small-scale lending has increasingly become commercialized, raising questions about the balance between financial stability and the original mission of poverty reduction. While microfinance has undoubtedly played a pivotal role in empowering millions, its operational models and practices have come under scrutiny for potentially perpetuating new forms of inequality and exploitation. At the heart of the ethical debate surrounding microfinance are several complex and intertwined questions. Should institutions offering microloans prioritize their social mission, or is profitability a valid concern? Are high interest rates justifiable given the risks involved, or does they exploit the poor? How should microfinance institutions ensure that borrowers are protected from over-indebtedness and aggressive lending practices? Microfinance institutions or MFIs aim to uplift the marginalized by offering loans to people like Sita. But how are they balancing their social mission with profitability? Are high interest rates an ethical necessity, or do they exploit the very people they seek to help? As microfinance evolved and scaled up, it faced criticism regarding its ethical implications, sparking debates that we will unpack today. Let's dive into the key areas of this ethical debate. Ethical dimensions of access to credit. Microfinance seeks to include marginalized groups such as women and rural populations who traditionally had no access to credit. By democratizing financial access, it strives to address social inequalities. Yet, while offering loans to individuals like Sita can empower them economically, the risk arises when borrowers lack financial literacy. If they are unable to manage loans properly, what was meant to uplift them can push them into deeper financial trouble. Next, interest rates and profitability. We have to charge higher interest rates. The operational costs in rural areas are enormous and the risks are at high. But at what point does this become exploitation? We are supposed to be helping these people, not drowning them in the debt. Hence, one of the biggest ethical debates surrounding microfinance is whether high interest rates, justified by operational costs, exploit the poor. Is it possible to maintain financial stability while staying true to the mission of poverty alleviation? Next, over-indebtedness. Over-indebtedness is another ethical concern in microfinance. In some areas, multiple borrowing leads to borrowers falling into debt traps rather than escaping poverty. MFIs have an ethical duty to ensure that borrowers fully understand the terms of their loans and their repayment capacity is properly assessed. Aggressive lending practices, as we have seen in some cases, do nothing but harm. Next, ethical targeting of vulnerable populations. Microfinance often targets vulnerable populations, women, the poor and the rural inhabitants. But there are ethical concerns when these populations lack the agency to use the loans freely or when they are misled about the terms. Financial literacy, especially in rural areas, can lead to ethical dilemmas. Are MFIs truly empowering borrowers or are they exploiting their lack of knowledge? Commercialization of microfinance. We need to expand and reach more clients, but that means making some tough financial decisions. Scaling operations is necessary, but we can't forget the people we are trying to help. If profitability becomes the main focus, we will lose the essence of what microfinance stands for. The commercialization of microfinance is another ethical dilemma. Can microfinance still serve its original mission while operating as a profitable business? Next, transparency and accountability in microfinance. Transparency is key to ethical microfinance. Borrowers should be fully aware of the loan terms, including interest rates and fees. Unfortunately, some MFIs have been accused of obscuring costs, leading borrowers into financial distress. Next, the role of regulation in microfinance. We need stronger regulations to ensure borrowers aren't being exploited. But too much regulation could stifle innovation and prevent MFIs from reaching those who actually need the most. Regulations play a crucial role in safeguarding borrowers. However, excessive regulation might limit the growth of microfinance. The challenge lies in finding the balance between protection and innovation. Ethical concerns about impact measurement. Measuring success solely by repayment rates overlooks the broader social impact of microfinance. Ethical MFIs should assess how their services truly improve the lives of borrowers beyond financial metrics. Next, the role of technology in microfinance. Fintech has transformed microfinance, making it easier for borrowers in remote areas to access loans. But with digital platforms come new ethical concerns such as data privacy and the impersonal nature of digital lending, which can make it harder for borrowers to fully understand the terms. The role of donors and investors. Our investments should align with the original mission of microfinance, empowering people, not just making profits. Investors and donors also play an essential role in the ethics of microfinance. Profit-driven investments may push MFIs towards unsustainable practices, while ethical investors ensure that social impact remains a priority. As we have seen, microfinance has immense potential in change lives, but it's fraught with ethical challenges. So to conclude, MFI's regulators, investors and borrowers must work together to ensure fair practices, transparency and a balance between profitability and social impact. Only then can microfinance sustainably achieve its original mission of empowerment and poverty alleviation. While microfinance has proven to be a powerful tool for promoting financial inclusion and reducing poverty, it presents significant ethical challenges as well. Ensuring fair practices such as transparent lending, protection against over-indebtedness and balancing profit motives with social impact is very critical. As microfinance continues to evolve, stakeholders, including MFIs, regulators and investors, must prioritize ethical responsibility to safeguard borrowers' welfare and uphold the sector's original mission of empowerment and poverty alleviation. By addressing these ethical concerns, microfinance can sustainably fulfill its potential as a catalyst for positive socio-economic change.